Let's take a look at problem 6.3 as it discusses the information regarding a debt service fund. The transactions of a debt service fund can be derived from its financial statements. Derwin County issued $200 million in long-term debt to fund major improvements to the county's roads and transportation systems. The debt is to be serviced from the proceeds of a specially dedicated property tax. The accompanying statement of revenues, expenditures, and changes in fund balance and balance sheet were taken from its year-end financial report. Based on the data in the two statements, prepare journal entries to summarize the transactions in which the firm engaged. You should prepare budgetary entries, but don't need to prepare closing entries. So as you can see here, we have the revenues in property taxes and interest, and then the expenditures showing principal that's been reduced, the interest paid, and then from there we have the assets of cash sitting at year end, investments, and property taxes. And so our job is basically to prepare the necessary entries, the journal entries, to show the transactions that have taken place here. So I'm going to just show you, based on this information, as you can see here, let me go back to 6.3, that we show the budgeted revenues of $20 million, and then the actual revenues of $21,520 in property taxes, and then $50,000 in interest. And so the first thing we'll do is create those budgetary journal entries where we'll show the estimated revenues for property taxes and credit fund balance. Now remember, generally debt service funds will not have budgets prepared unless special property taxes or special assessments have been levied. So in this case, since that is the case, we will want to record this budget of a debit to estimated revenues for property taxes, credit our fund balance, and then the estimated expenditures we anticipate, we would be debiting that fund balance and crediting appropriations for the principal that's being retired and appropriations for the interest. Then money has been received from the Capital Projects Fund. How do we know that? We can tell here non-reciprocal transfer of bond premiums from Capital Projects Fund. Since we can see that that has come in, we will also report the cash of $150, and again, when transfers happen, we call them other financing use, non-reciprocal transfer from the Capital Projects Fund, transfer in from the Capital Projects Fund. Then we'll also want to show the property taxes. Again, if we go back here and see that what actually came in, $21,520,000, we'll want to show those property taxes. And so we've got here property tax revenues of $21,520,000. We have the cash, and the reason we know we've got the $2,150,000 of property tax receivable, you'll be able to see here on the books here of $2,150,000 as of the end of the year that have not yet come in. So that is how we were able to come up with this entry of showing what in fact was received in cash for the property taxes. Next, let's go back here and let's look at the next portion, I should say the next journal entry will be the expenditures. Now let's look at what was estimated and then what actually occurred. It's the same, the budget versus the actual. We have expenditures of the principal being reduced or retired and the interest. So to go back over here, we've got expenditures, principal retirement, expenditures interest, with a credit there for cash of $18,500,000. We also can tell from the financial statements that there is now an investment of $1 million. And so we will record that journal entry, investments to be debited, cash to be credited. And then lastly, we received $50,000 in investment revenue. So we will debit our cash and show that credit in investment revenue for that amount. So that takes you through problem 6.3, and again, go over this as many times as you need to be able to cement and understand how we have come up with those journal entries based on those financial statements.